A silent crisis is rapidly growing, while most of the United States remains focused on the looming burst of asset bubbles, with politicians and policymakers artificially fueling an economic boom to hide the cracks that are threatening to break our entire system. As our businesses go bankrupt and our workers continue to be pushed out of the labor market, the foundations of our economy have started to crumble due to the overwhelming amount of debt accumulated up until this point. Corporate debt, housing and commercial real estate debt, and of course, our debt-fueled growth are all weighing upon U.S. banks like never before. But this time is different, they say, while trying to persuade us that everything is under control. The truth is that America's debt load, including households and businesses, is setting the stage not only for a brutal bank collapse, but also putting us at risk of experiencing the worst financial crisis in all of our history. As insolvency risks mount and delinquency rates soar, banks will have to face a fatal blow. That is to say, all evidence is pointing U.S. banks and other financial institutions will be forced to absorb a staggering amount of non-performing loans, which will lead to billions in losses and result in a credit crunch that will impair the growth of our country for decades. Even though the health crisis did not start as a financial meltdown, several economists are warning it is quickly morphing into one. And that's what we're going to expose today. So stay with us and don't forget to leave a thumbs up, share this video, and subscribe to our channel to keep updated with our latest notifications. A quieter crisis is now gaining momentum as the financial fallout of the health crisis has generated a monumental mountain of debt, and non-performing loans are threatening to collapse U.S. banks and several other financial institutions and jeopardize economic recovery prospects for years to come. That's what the Vice President and Chief Economist of the World Bank Group, Carmen Reinhart, recently warned, stressing that the current monetary policies aren't expected to help mitigate the risks of a financial disaster. Instead, they've actually pushed us to a dangerous debt spiral since our economic boom has been artificially supported by money created out of thin air. Reinhart argues that banking crises usually arise after a period of heated economic activity. In the United States, growth is oftentimes stimulated by a credit expansion and rising leverage. Although authorities continually claim that this time is different, during periods of expansion, they find a pretext to fuel asset price bubbles, whether in property, commodities, equity, or bonds. However, as our economic activity has considerably slowed down and turned into a steep recession, loans made during the good times have started to go sour. And when balance sheet problems begin undermining confidence, runs on banks and financial institutions rapidly turn the crisis into a fully fledged panic, the Economist explains. Households and businesses can try to deleverage after the crisis as the same banks adopt tighter lending regulations. But if banks insist on overlooking bad loans, the resulting credit crunch may trigger an ever deeper recession. However, as Reinhart highlights, this time truly is different. The run-up to the credit crunch expected to occur in 2021 transcends the historical boom-bust narrative we've seen before. First, because we haven't experienced a lengthy economic expansion as it happened in the periods that preceded previous credit crunches. Second, because we don't have one but several overly inflated asset bubbles. Third, because the imminent balance sheet crisis and the credit crunch will likely extend longer than in other historic periods due to the potential persistence of the slump in economic activity. And last but not least, Now we have a profoundly regressive crisis, disproportionately impacting low-income households and smaller firms that have fewer assets to pay their debt and avert insolvency. Even though it might be too soon to say we could witness a downturn of Lehman proportions, we cannot surely affirm this possibility doesn't exist, especially considering that the longer the economic recession persists, the more asset quality will deteriorate, particularly in a time when several businesses and households remain highly leveraged. In years of bank lending to corporations that became unproductive due to the consequences of the current crisis, as well as individuals who lost wealth and income, will take a risky and cumulative toll on balance sheets. Crises like these come with an alarming amount of costs for banks, and since restructuring and recapitalization plans to re-establish solvency can be too expensive for governments and taxpayers, new lending will remain depressed, which means economic activity will stay impaired. It also worsens the overall economic conditions, as those who rely the most on credit are small and medium-sized businesses and lower-income households, and with limited to no access to credit, they cannot fund new expenses, and therefore they cannot help to boost the economy. Different from most previous crises, after the sanitary outbreak exploded, the government's expansionary monetary and fiscal policies were supported by banks through macroeconomic stimulus with a variety of temporary loan moratoria, as the International Monetary Fund has reported in its policy tracker. On one hand, it helped to provide short-term relief for many households dealing with unemployment or income declines, while it also offered a lifeline for some businesses to survive several rounds of government-mandated lockdowns and other major disruptions to normal activity. Banks and financial institutions granted forbearance periods for repayment of existing loans, and many have recontracted loans due to lower interest rates. The underlying logic was that because the health crisis is temporary, so would be the financial pain of businesses and households. But, on the other hand, as the pandemic has persisted, many banks have been forced to extend these measures up until now, and in this process, they had to cope with an excessive amount of debt that has been critically weighing upon balance sheets. On top of that, as Reinhardt noted, many banks decided to temporarily relax regulations regarding bad loan provisioning and the classification of loans as non-performing. The consequence of these changes is that the extent of non-performing loans has spiraled out of control, and in many cases, banks and financial institutions won't be prepared to handle the impact this will have on their balance sheets. Fewer regulations often lead to greater exposure to risk. Adding to these factors, downgrades of sovereign credit ratings reached a record high in 2020. And even advanced economies like ours have not been spared. So, the consequences for banks will be extremely acute, as sovereign default and restructuring will force them to take losses on their holdings of government securities. Even more concerningly, according to the U.S. Federal Reserve's November 2020 Financial Stability Report, policy fatigue or political constraints indicate that the next U.S. fiscal and monetary stimulus will not match the scale reached in early 2020. In short, this means that the United States has expanded its money supply far too much, and we're nearing monetary policy limits. Simply put, when banks start to crash and the financial system is taken over by panic, Federal Reserve's measures won't be able to bail us out from this catastrophic downfall. And as 2021 unfolds, and our economy faces numerous challenges such as rising interest rates, higher inflation, higher prices, as well as unexpected supply chain disruptions. Many industries and households will continue to face severe financial setbacks, which implies that insolvency risks are expected to increase, and U.S. banks will continue to face a marked rise in non-performing loans. The IMF has frequently warned about the critical surge in dollar-denominated corporate debt in many emerging markets, but exposure to the downfall of the hospitality industry, the ongoing retail apocalypse, and the commercial real estate collapse in particular are other sources of concern for banks. Since the burst of the outbreak, the rapid deterioration of the commercial real estate sector was sparked by a major change of habits, as employees started to mostly work from home, and online shopping has accelerated the decay of brick-and-mortar retailers. The future of the sector is still uncertain, as physical stores and shopping malls face an existential crisis and companies dump their office space. In turn, that has caused an enormous impact on rents, with late payments marking the range of hundreds of billions of dollars. That's the very reason why the Deputy Director of the Monetary and Capital Markets Department outlined in a recent interview that we're definitely not out of the woods yet for a couple of reasons. He said one is that, historically, if you go back to the financial crisis, there was a difference in time between how equity markets, for example, reacted. So they dropped sharply and they recovered in 2008, but the realization of losses in the commercial real estate took longer. Similarly, a financial sector expert at the IMF, Andrea Deghi, highlighted that the future of commercial properties could become an enormous issue for our financial system. In a nutshell, the sector is relevant for financial stability mainly for three reasons. The first is because of its large size. Secondly, it heavily relies on the debt funding and is also strongly interconnected with other sectors of the economy. Adding that, if a slew of businesses in the sector were to collapse, then that could add pressure on banks who've lent money to them. Banks could incur very large capital losses. Even the Congressional Budget Office released a report alerting that America's huge corporate and household debt load, in addition to our skyrocketing national debt, are heightening the risk of a dramatic financial crisis here in the United States. If the pace of debt creation doesn't ease up shortly enough, our federal debt will hit 102% of GDP by the end of this year. Such high debt levels could increase borrowing costs, slow economic output, and increase the danger of a financial crisis, the CBO said. High debt levels will slow income and wage growth, increase interest payments, place upward pressure on interest rates, reduce the fiscal space available to respond to a recession or other emergency, place an undue burden on future generations, and heighten the risk of a fiscal crisis. The Committee for a Responsible Federal Budget, that's a nonpartisan group, said in a statement. Furthermore, a new Fitch Ratings survey forecasts a biblical surge of bankruptcies among small and medium-sized firms to occur this year and extend throughout the next few years. In the new study, the rating agency stressed how government support and forbearance arrangements impacted bankruptcy processes, which have artificially depressed bankruptcy filings over the past year. But as credit losses are expected to significantly increase, Fitch have projected that banks' non-performing loans will peak in 2021. A faster-than-expected surge in bankruptcies and non-performing loans could tighten credit conditions, weighing on the recovery, it said. Indeed, as the damage done to banks' balance sheets take a long while to repair, it oftentimes results in a long period of deleveraging. And going through a deleveraging period at the same time as asset bubbles burst and the economy fails to recover, will make us fall deeper into the recession, and it might take decades to actually rebound from that. And even if the Federal Reserve tries to print loads and loads and loads of money to prevent a financial catastrophe, in essence, the financial crisis might turn into a sovereign debt crisis as bailouts transform pre-crisis private debt into public sector liabilities, as Reinhardt pointed out. Now, keeping in mind that households and corporations in the world's two largest economies, the United States and China, are highly indebted and include many high-risk borrowers, a banking crisis on both sides of the world will undoubtedly trigger the worst financial meltdown we have ever seen. At this point, the national debt has surpassed the $28 trillion mark, while asset bubbles are ready to burst and insolvency risks multiply as our businesses continue to go under. Needless to say, banks will soon be overwhelmed with a colossal amount of debt coming from several sectors of the economy, so this silent crisis will evolve into a roaring explosion. And while banks collapse, the financial system will break down and our economic growth will remain stalled for years and years. Dark clouds are ahead, and we should all brace for an era of widespread decay. And you should stay tuned to the Epic Economist channel to be informed with the next unfoldings of this ravaging crisis. Thank you very much for watching. See you on the next one.